Good morning, everyone. Thanks for joining us. We have a terrific panel today to talk about the future of asset management, but I wanted to start first by engaging you all in a poll. I believe there are clickers on the sides of your chairs where we may be able to take a poll. We're going to experiment with this. It's essentially about what you see as the biggest risk in the markets over the next 12 months. So A would be if you think it's going to be geopolitical tensions, B for the Fed tightening, C for accelerating inflation, and then D for weak growth in emerging markets. So if you all want to take a minute and think about what you think is actually the biggest risk over the next 12 months, we'll see if we can get an answer there. Interesting, far and away, geopolitical tensions. And weak growth in emerging markets, only about 2% of you, so that's interesting. Terrific. Well, Cyrus, I'm going to toss that to you first in terms of we're seeing a lot of change in the markets this year. Obviously, geopolitical tensions, rising interest rates. What do you think that bodes for the future of asset management, that return of volatility in the markets?
Yeah, so similar to the poll, we do see a lot on the geopolitical side, but I just add another risk, which, to be fair to the audience, wasn't on the multiple choice question, which is we see this shift from massive monetary stimulus to fiscal policy, sort of picking up the baton, if you will, in a relay race. And as you know, that's where stuff often happens, as in, somebody could drop the baton. So that's the background. So we do see definitely more uncertainty and volatility. So in that context, what does it mean for asset managers? And I'll really focus on most asset managers who are active, and I'll try to focus on the mainly long only, because I'm sure we'll come back and talk about alternatives. So I think there's good news and there's bad news. I think there's terrifically good news insofar as that this is the time and the environment where active managers typically outperform. So that's good. And we've seen that in Q1. More than half of active managers outperformed their benchmark, including in US large cap, and about 75% in Europe. So that's great. The bad news is I think the bar and what it means to be really active continues to rise. I believe that the factor revolution is not going away. So it's not any longer simply market cap weighted indexing, but increasingly it's clients disaggregating and decomposing the sources of their returns and asking, what of the returns of my active managers can I get in a more capital effective way through factor-based exposure? And then there's still a wonderful area for the true idiosyncratic alpha managers. So that's how we see it, but definitely the bar is going to go up, and my guess is consolidation is going to increase over time.
So consolidation among asset managers.
Yep.
Interesting. So Yie-Hsin, you sit at a company, New York Life, that's 173 years old, so over a century old. As a CEO within that company, how do you actually position it for the future, given that it has such a long tail of history?
You know what that I think about New York Life Investments is that we're really the best of both worlds. Independent investment boutiques together with this long-term heritage, long-term perspective of New York Life. And what's really important to know about us is that we really come at this business first and foremost as an investor. So New York Life has been around a long time, through Civil War, 2 World Wars, the Great Recession. And today we're stronger than ever. And in fact, we're only one of a handful of AAA-rated financial institutions around the world. And so our approach is really to focus in on, take the time to really understand the problems that our clients are facing, what are they trying to solve for, and we do for them as we do for ourselves. And so as CEO of this business, this embracing of a multi-boutique culture, which I believe really attracts the best and brightest in investment talent, together with this incredibly strong foundation, has given me the opportunity to really expand the business geographically as well as by asset class. We've moved into Europe and Asia through the addition of several boutiques and offices across Asia. We've leaned very heavily into alternatives. It's an area that I've spent a good portion of my career and I believe really has a place in every portfolio. And even to Cyrus's point, very much focusing on innovative factor-based ETFs. And so the overall approach that I have taken is to focus in on a couple key principles. One is aligning ourselves with our clients, and then secondly, with conviction. And so as we've developed new solutions and strategies, our focus is investing meaningfully alongside our clients.
So David, to bring you in here, so Cyrus mentioned long only, Yie-Hsin mentioned alternatives. One of the things that you think is fascinating in the industry right now is the convergence we've talked about of long only and alternative strategies. What are you seeing there, and how do you see that playing out in the future of the business?
Sure, and it's certainly one of the more interesting trends that's happening in the industry. And it goes back to the framing of your first question for the audience, which I thought was fascinating, and I think completely and utterly misleading. So why is it that we think volatility is risk? I mean, our clients are basically long-term investors. They're sophisticated pension funds, sovereign wealth funds. They don't lose money unless they impair an asset or they sell it for less than they bought it for. The market going up or down does not create a loss for them. And I think that's a really important concept. For many of our investors, the biggest risk that they have today is putting money out in an effective way. Prices are very high around the world, around asset classes. And the idea that whether or not we have a little more volatility, which much of us actually thinks is good, the markets are supposed to adjust prices to reflect risk. And so that is actually a healthy market. 2017, we would argue, was strangely calm. And that was the abnormal situation. This is much more normal, and we should actually embrace market volatility as giving an opportunity for long-term investors to get into the market at a good entry point. So I just think this notion that volatility is risk, we need to do away with that quite quickly. But let me come back to your question about alternatives. So one of the real advantages, obviously, of alternatives is that it doesn't mark itself to market every day. Alternatives have been shown to be an important part of any long-term investor's portfolio. We've done a lot of work over the last 30 years looking at not just the returns, but also the correlation of these asset classes to others. Because remember, people have this in their portfolio not because they think private equity necessarily will be a higher return, although that's been true, but because it isn't correlated to the equity markets completely. And that turns out to be right. So real estate, private equity both offer correlation benefits and return benefits. Hedge funds, not so much. Some relative value, but most of them actually are quite correlated. But when you put it all together, a long-term portfolio should absolutely have a range of alternatives in it. And I think we, along with many other asset managers, are responding to that by being able to offer a broad range of asset classes across both long-only and privates. We're about 40% of our business is